Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name's Tom Rosine. Thanks for joining me today. I'll be reporting flows for the week ended June 11th, 2014. I don't think anybody will be surprised if I tell you that we saw inflows today or this week. About $2.7 billion entered the conventional fund business. We'll be talking a little bit about ETFs as well later on, but this is just the conventional fund business again. And it's the second week in three that we've actually seen inflows. And so this hasn't been something that's been going on as much as people have been talking about, because a lot of that was due to ETF inflows. But let me give you kind of a rundown of why this happens. You know, really, we had kind of a discouraging news on the very last day of trading on Wednesday, when basically the World Bank came out and said, hey, listen, we're going to readjust our growth rates. We had, obviously a lousy first quarter because of U.S. and horrible weather, and certainly people are still concerned about Ukraine and Russia. So we're going to go ahead and revise our growth plans down, and I think that put a little bit of hamper into the rally that's been going on. But prior to that, we had the S&P 500, Dow actually hit all new time highs again. This has been on really low numbers, kind of marginal increases and very low volume, but still was a rally nonetheless, and it's been a pretty good run. And it was justified. We saw non-farm payrolls actually come in about 217,000, which was above, I think it was 210 that was expected. And then we also saw again those new market highs. And the last piece I think that was encouraging is we saw that China actually had some really good export numbers as well, so that lifted people up, saying global growth might be better than not. So that's what they were looking at, and certainly kept investors engaged. Why don't we go ahead and take a look at how this, the economics and stuff actually panned out into our global flows, or flows for actually U.S. funds. If we take a look at our macro group equity funds, so about $2.4 billion net new money coming into their coffers. Taxable bond funds, so about $1.6 billion net new money. Muni bond funds, again, so about $0.3 billion, $300 million into their coffers. And then we saw small outflows, about $1.6 billion out of money market funds. And certainly that's how we got there. Obviously, money market funds have been really a drag on inflows into the conventional fund business, but again, for the last several weeks, that has not necessarily been the case. Let's take a look at equity funds and how that panned out on a kind of a group-by-group basis. We saw about a 1.15% return for the week. Again, we saw some good numbers out of NASDAQ, saw some good numbers out of the S&P and Dow. Again, they hit new records and the like. And for the NASDAQ, actually, it was the fourth consecutive week that they've had upside performance, so that was kind of an amazing feat. There was a third consecutive week, though, again, that we saw the plus side performance, 1.15% here on the fund side. We saw about $2.4 billion net new money come into the coffers, and this is the second week the 21st consecutive week that we've actually seen inflows. Domestic equity funds, though, saw about $600 million of inflows, not a lot of money, and keep in mind this number because we're going to get to ETFs later on. You're going to see there's kind of a dichotomy, but domestic equity funds, about $600 million. It's the first week in three that actually they've seen net new money. However, if you get to the point where we're taking a look at non-domestic equity funds, that's where we saw all the money come into, about $1.8 billion come into their coffers. This is the 26th straight week that we've seen money, actually investors pad, the coffers of the non-domestic equity funds. It was quite a change. Now, how this broke out, though, if we take a look at it, we saw small caps get beat up a little bit. Is another thing I want you to remember as well. I'm going to tell you a little bit later on, ETFs saw some good money roll in on the small caps, but investors still continued to shy away from small caps. They only saw about $274 million of money leave their coffers. But if we take a look at international equity funds, $1.6 billion of money came into their group, and emerging markets actually took in a nice chunk, about $600 million of money coming to that group's coffers as well. Now let's take a look now, if we start focusing a little bit more on ETFs. Now the ETFs were kind of a big change. We saw a third consecutive week inflows, $7.6 billion net new money. How it broke out, though, is the biggest intake was the iShares Russell 2000. Remember, I told you open-end funds were still bailing on this. Apparently, the authorized participants, actually maybe see some light at the end of the tunnel, or maybe with the bathwater thing. So maybe they come out and they're trying to get a little inventory. So when we want to turn around, retail investors go out and buy that, we have that inventory. They certainly don't want to be hanging on to inventory, so they must know something we don't. If we take a look also at the SPY, Spider S&P 500, they saw the next largest inflows, about $1.5 billion. Well, that takes us to the bottom of the list, and what we saw was the Wisdom Tree Japan hedged equity funds. Keep in mind now we've had all the money going into non-domestic, and then we saw at the bottom of the barrel the Wisdom Tree Japanese hedged equity funds losing about $500 million. And then the next worst performance is the iShares U.S. real estate ETF, also seeing about $400 million in outflows. So not a real big story there, but certainly a dichotomy that we've seen between the retail investor and what I'm going to call the institutional investor, as we take a proxy for ETF investors. As we know, net new money coming into that group is really from authorized participants and not from you and me as retail investors. Let's take a short look at fixed income funds and see what happened in that group. For the 23rd consecutive week, we've seen inflows about $1.6 billion. This is the third consecutive week that we've actually seen plus side performance, 0.25% return, not bad. At the top of the group, we saw flexible funds, taking about $641. This is the 23rd consecutive week they've taken in money. And then a new entrant actually getting up there. People actually put on a little more risk in the portfolio. High yield funds, so about $437 million of money coming into that group. Now, if we take a look at the old corporate investment grade debt funds, they had a little bit like $133 million in inflows. It was very low, but the reason why is a subset of that group: loan participation funds, or bank rate funds, or bank loan funds, or bank leverage funds. All these different names have acronyms for kind of the same group. They actually saw $1.2 billion in outflows for that group. Now, this is the largest outflow that we have seen since it was August 17th, 2011. So certainly it was a big outflow, and it's the 8th week in 9 that we've seen outflows out of there. So investors must be less concerned with rising interest rates, or imminent rising interest rates anyways, even though we saw a nice bump with the 10-year Treasury in the last week as well. We saw some rise above the 3.5 area, and that's what people were so concerned about. But in any case, there was just something that we wanted to point out and let you know. Let's take a look now at what happened on the ETF side. It wasn't quite as a drastic change. We saw outflows actually in this case about $400 million. As fifth consecutive week we've seen outflows. How it broke out is we saw iShares 20-plus Treasury Bond Fund ETF taking about $455 million. And on the downside, we basically saw the iShares 1 to 3 Credit Bond Fund lose about $940 million. So not really a lot to write home about there, not a lot of discrepancies like we saw in the equity market, but certainly of concern as people were taking a look at what the authorized participants were doing there. Well, now let's turn our attention towards muni bond funds. Muni bond funds actually saw inflows, about $295 million of money coming into their coffers. It's the 6th consecutive week that we've actually seen flows, on the inflow side, and it's the 2nd consecutive week, though, that we've actually seen negative performance, 0.18%. But we found that a little bit ironic that we had actual negative performance in the 6th consecutive week of inflows in that group. National munis actually took in the lion's share, about $318 million. That would let us all know that the single states actually were in the red once again for the week. Now, if we take the temperature of what's happening in money market funds, we'll see it wasn't really a big week for money market funds, as I said initially in this conversation. It's the 5th consecutive week that we've actually seen outflows, about $1.6 billion in outflows. Taxable money market funds, so about $400 million in outflows. And how that broke out is institutional investors actually put in about $1.4 billion, while retail investors, or retail money market funds, actually saw about $1.8 billion in outflows. And tax-exempt money market funds saw a big chunk of change leave their coffers, about $1.2 billion in outflows. So that just brings us to the end of our conversation, and basically a couple things came out over the last day or two. Yesterday on the 12th, we saw retail sales actually rose only about 0.3% when I think the market was actually expecting a 0.6. So a little bit disappointing numbers there, and we'll have to see how that pans out for this week as far as flows goes. And then also we saw that the May purchasing price index actually was down about 0.2% when we thought analyst expectations were hoping for a 0.1% rise. So certainly that plays into the how people are viewing the economy, whether they're feeling comfortable with interest rates and where they're at, and certainly how the equity rally will continue. Well, that's it for me. If you want to do a deeper dive into a section I haven't covered, a group that you want to cover, a classification you want to take a look at, you can go to our site at lipperusfundflows.com and do a deeper dive yourself. If not, join us next week. One of the analysts will be telling you about the flows for that current week. Thanks for joining me, and my name is Tom Rosine, wishing you the best in your wealth planning and creation.